If anybody's out there, hashtag coffee break. We'd like to hear from you. All right. I think we are good to go. And welcome to this week's edition of the Construction CPA's Coffee Cafe. I am the Construction CPA, Lisa Raish. We are dropping the hammer on cash flow problems so you can build things that matter. This week's topic is reasonable compensation, or the criteria for determining reasonable compensation. We work with a lot of S Corps in this particular practice here, and many businesses out there are actually S corporations. So this is a good topic. This is an important topic. One of the things that is important when you have a lot of times when you move into an S corp status, a lot. You may incorporate as an S corp. You might be an LLC and make the determination that you want to file as an S corp. A lot of times choosing the S corp is, in most cases, a tax strategy. And that strategy is chosen to help you reduce your overall tax liability, or at least minimize certain aspects of that. So when you're in other structures, i.e., a sole prop or potentially in a partnership structure, you will most likely be subject to self-employment tax. And in many cases, when you are electing to incorporate as an S corp, whether you start off as directly moving into an S corp, or if you're an LLC electing to be an S corp, typically it's done to save on self-employment tax. So that being said, a lot of times what happens is you get into this S corp situation and you want to save the self-employment tax. You don't want to pay into FICA. And the idea is that, oh, I won't pay myself any salary. I'll pay myself as little salary as possible, and I'll take it all in distributions. The issue with that is the service believes that somebody needs to be running that business, and therefore that somebody needs to be making a reasonable compensation. And that's typically you, the owner. So there are rules and there are regulations around the reasonable compensation that you need to kind of think about and take into consideration when you are establishing yourself. And it's not just an S corp; it could be a C corp as well. I'm going to make reference to the S corp a lot. It's just because we have a lot of clients that are in that particular. They're structured that way, and many businesses are in fact structured as an S corp. So it tends to be not a default. It isn't a default, but it tends to be a structure a lot of businesses choose to go into when they incorporate. So again, this is both an S corp or a C corp. So when you are incorporated that way, the entity itself is a structure. And so there are going to be legal requirements to paying not only the shareholders' compensation, but reasonable compensation for all employees and all key employees. When the service comes in to do a reasonable compensation audit, what they're looking for is they're looking to determine whether you're paying yourself reasonably for the work that you're doing. And that's pretty much like, and I know it sounds basic, but it really is. So if you are the chief, the cook, and the bottle washer, you should be paid as if you were the chief, the cook, and the bottle washer. And that's where you start to build out that reasonable compensation. So there are going to be criteria for your industry, right? So for example, we work with a lot of construction. So and if you're operating as the chief salesperson or the chief business development person in your business, you're the one going out and meeting people, getting new contracts. So you are the business development salesperson. If that's what you're doing in your business, what would a business development person be making if you, in fact, weren't the person doing it in your business? And that's really where the reasonable comp, really the structure and the base of it lies in. If you left your business and needed to hire a person to, in fact, do the thing you're doing, what does your industry say that person is going to cost you? So you want to look to see in your industry, what would I pay for a salesperson? What am I? Oh, I'm the chief project manager. I manage all of the job sites. What would that person cost? What would that person, if you brought them in, expect to be paid in your industry, in your part of the country? That's a big issue too. What part of the country are you operating out of? Are you in a more rural part of the country where salaries may not be as large as they are on the two coasts? The cost of living on the two coasts are going to be higher, so those particular individuals may actually be paid a larger salary. So something to think about. What's your company's financial performance, right? What's happening in your business? Now, if you're running into some challenges and you're having cash flow problems, typically the first person who's taken off of payroll in most cases is going to be the owner or the shareholder. And in that case, that is okay if that happens, because that's a strategic business decision that you're making in order to kind of keep yourself afloat. Now, if you've taken yourself off of payroll and you're still continuing to take distributions, then that in turn creates a problem, especially if you were to come under audit before Internal Revenue for reasonable compensation. What are you doing in your business? How qualified are you to do that in your business, right? Are you really good at business development? If you really were great at business development and you went to go work for somebody else doing the same identical thing, what would you expect to get paid? Now, if you're not that great at it and you're training somebody and somebody's new to it, maybe that person wouldn't be paid as much. But again, those are the things that you want to think about. How good are you at what you do, right? You might be doing your own accounting in your business. That's fine if you are, but if you're not really great at it, again, you want to, if you're doing that along with doing your business development and you're the PM and you're the marketing person, you really should be getting paid to do all of those things in your business. But of course, according to your skill set, how good you are at it. I'm not great at marketing. That's why we have other people do our marketing. But if I was doing it myself, I'm not great at it, but I would need to think about that when I'm developing out my reasonable comp because, well, again, I'm the chief, the cook, and the bottle washer. Oh, and the marketing person, right? Those are all the things that you want to think about. How good are you at, how experienced are you at it? How qualified are you at what you're doing? So again, if you're the business development person and you're starting out and you really don't have a lot of experience and you're not as qualified, your salary may not be as high because you don't have the qualifications or the skill set or the experience that someone else would have. And that all gets factored into your reasonable compensation. And the IRS really has pretty solid guidelines around this. And I'm going to kind of read this little blurb that I have here. And just to kind of give you an idea. So basically, shareholder employees, so the IRS requires S Corp shareholder employees to receive a reasonable employee salary, which is generally defined as at least what other businesses pay for similar services. That is it in a nutshell. There are nuances to it. There are ways to calculate it. We do reasonable comp analyses for clients. We do want to make sure that they are paying themselves appropriately, especially for the industry and where they're located. And then in accordance to, how much they're taking in distributions. We want to make sure that all of those things are in line with what is expected. There are a lot of compliance challenges in any business, and we don't want reasonable comp to be one of those compliance things that, cuts you off at the knees and has you wondering what exactly should I be doing? So we do that. But the reality is if you were to be audited by the service, they're going to come in and they're going to be looking at what you're paying yourself. So if you think that you're going to, in their eyes, evade paying taxes, i.e. evade paying self-employment taxes, which is really FICA when you're an employee, it's all the same thing. You can't disguise your salary as distributions. You can't take zero salary and then take $250,000 in distributions out of your business in a year. The service looks at that and says, okay, that's clearly what your salary would have been. So if you are, in fact, audited, they come in, they look at that and say, reasonable comp in your industry, in your part of the country is $200,000. and they reclassify those distributions and now they're payroll. And now you're liable for payroll taxes and penalties and interest on late and underpayment and so on for whatever period of time that they've made this recharacterization of your salaries. But again, there's you could pay tax penalties of up to 100% plus negligence penalties as well. That's a very, very expensive adjustment to be made when you can in fact do some analyses early on and determine what you should be paying yourself and paying yourself appropriate. Now, you don't want to do it at the detriment of your cash flow. So you may not be able to, industry standard may be you should be paying yourself $100,000 a year for what you're doing. But if you've run into cash flow challenges, no, I can absolutely see. I've seen clients do that. They pull themselves off payroll for a short period. They try and kind of clean up or even up their cash flow challenges, and then we put them back on payroll. Again, if you're taking yourself off payroll to save money, but you're still taking distributions, that in terms can be a problem. So you really want to sit down with your professional and determine what reasonable comp should be in your industry, in your part of the country, and really mapping out what exactly are you doing in your business. Because we do that. We do a full analysis. We ask a number of questions. It's actually a pretty long questionnaire. All the things you're doing in your business. What exactly are you doing? And when I joke, I say the chief cook and the bottle washer, but you're the chief salesperson and you are also doing your marketing and you're also the one handling your QuickBooks file and you're doing payroll every week and right? Those are all things in your business that you should be paid for. So again, those are things that you want to look at. You want to pay yourself reasonably based on your training, your experience, what you're actually doing in your business. Now, on the odd side, the other thing that you want to look at, and we've run into this a number of times this year alone when doing tax prep for clients, is the real miss between reasonable comp and distributions, to the point where distributions now are becoming taxable to you. Your S Corp distributions, because you are exceeding your basis, you're exceeding your equity in your business, and therefore now it becomes taxable. So you've created a taxable situation, but we've seen it in a couple of situations as well as they've also created a cash flow problem. Clients come to us and they say, well, I have a cash flow problem. Yes, you are the cash flow problem client because you're taking a salary. And for a handful of them, they're actually taking reasonable compensation. But they're taking absorbent distributions beyond that. Distributions now that have become taxable to them, which has become even more expensive. But the real heart of the issue is they're pulling all the cash out of their business that they need in order to operate in the upcoming weeks. So there's really a fine line between reasonable comp and distributions and over distributions. But these are things that you need to look at. And we review these things on an annual basis with clients because things in their businesses may change. You may be doing more this year than you were doing last year. You may be doing less because now you've built out your team and you've really honed in on doing one specific thing versus, again, being the chief, the cook, and the bottle washer. As you grow your business, now you have other people doing these things. So those are the kinds of things that you want to look at and you want to review on a regular basis. You want to document it. Right? We do reasonable comp reviews for clients where we document it. We do our analysis, we pull information and we pull data from the area of the country they're operating in, what their revenue range is, what they're actually doing in their business. And we build out a full analysis to support the reasonable compensation that we are now paying the client. So it's important that you are clear on what those dollar amounts are. If you have partners in your S Corp, you want to make sure that there's transparency between each partner as to who gets paid what, for why, and for what they're doing in the business. Some may have one skill set, another has a different skill set. Again, why? You need to have that constant communication with shareholders. And as always, we recommend you work with your professional to help you develop out what that reasonable comp really should be. Again, it can be, it's a lot easier to kind of get ahead of it It's easier to get ahead of it and do it correctly the first time than it is to kind of go back and fix it after the fact. I've been through reasonable comp audits. The IRS will absolutely recategorize distributions and other things that I had a client who they recategorized some expenses that weren't deductible to them. They actually should have been non-deductible, and they just recategorized everything as compensation to the owners. It gets very expensive, and it is one of those things that can honestly be um, it, it can be avoided. It's not something that you should have an issue with because there's so much information out there now where you can build out a reasonable compensation analysis and pay yourself appropriately and then take your distributions appropriately. So again, reasonable comp is all about what are you doing in your business right now and are you paying yourself appropriately for what you're doing? If you are running a $5 million business and you're paying yourself $25,000 a year as the owner of that business and doing all the sales and supervising all of the team members, 25,000 a year will not be reasonable compensation in any part of the country. So you want to make sure that you're clear on that. You want to be clear on what exactly your skill set is, what you're qualified to do, how well you do it, and build all of that into your reasonable compensation analysis. There, with that documentation, you can now determine what your reasonable comp is and pay yourself appropriately and then offset it with distributions from profitable businesses, really creating that overall compensation package for the owners. As always, we love to see you here every Friday morning on the Construction CPA's Coffee Cafe. If you have any questions, feel free to drop them in the chat. We'd love to hear from you. We would, answer any. We try to answer all of your questions as quickly as we can. So we look forward to seeing you here every Friday. I am Lisa Raish. I am the Construction CPA. We are dropping the hammer on cash flow problems so you can build things that matter. It's great to see you. Have a wonderful weekend, and we'll see you here next week.